But since we've got quite a nice number of people, let's try and make this event cozy. So feel free to turn your cameras on. It's always nice to see faces. Similarly, like our last event was Kuroshike. That was really well received. But without further ado, on to our introduction. So essentially, we're joined by Sacha Ghebali from Kaiko, and essentially this wouldn't have happened if it wasn't for Mo, who knows Sacha from way back when. And yeah, I guess, many of the audience, you'll be aware of the crypto markets kind of popping off the chain at the moment, to say the least, with massive price swings and Bitcoin hitting all-time high and $1 trillion market caps. But let's see what Sacha has to say, someone who's very experienced in the space with a PhD in Aeronautics from Imperial College London and also an alumnus of MIT. Hopefully he'll give us some extra bit of insight, especially coming from a company like Kaiko with their key data analytics of blockchain. So over to you, Sacha.
Thanks a lot, and it's a pleasure to be here today. I think it's really important to work together and try and inspire new talents to come into this space. So I'll start sharing my screen, and I'll try to give quick. Okay. Can you see my screen?
Yes, all good.
Awesome. Cool. So yeah, I'll try to keep the the slide part relatively short so that we can get into a more interactive discussion. I think it's the best way to get the most out of this kind of events. So I'm more than happy to do some follow-ups later. You'll have some contact information at the end. Feel free to reach out about any of this. So let's get started. And as you might know, recently everything has really accelerated in the cryptocurrency space, and we've seen with Bitcoin. What is really special about this year is the level of institutional adoption that we've seen. All the big names in Wall Street have started, announcing that they were thinking about cryptocurrencies and Bitcoin in a way or another. Other publicly traded companies started putting Bitcoin in their treasuries, which is something unprecedented. We've seen billions of dollars being allocated. Elon Musk recently announced also an allocation, as you can see on this chart, just until the beginning of the year was already difficult to keep track of all the events going on in the institutional space. And this has continued since. However, there's a lot of growth, but there are many different companies, different startups trying to do the same things in a way or another. And that's what you get with this vibrant entrepreneurship environment. You get into a somewhat fragmented and not very transparent ecosystem. So hopefully this is something that will consolidate as we go. There are always concerns of market manipulations. Very famous economists, or like Rubini of NYU, saying Bitcoin is completely manipulated, and that might be true. One big challenge when you go now trying to see all those big exchange places being audited is accrual accounting is really hard, and how do you do it properly? How do you value crypto assets is really difficult. And a little, the big question for you, me, and also institutional investors, asset managers is: should you get exposure? How much, when, and how to do this. So I just want to give you a little glimpse into what has been going on recently in the trading infrastructure, more around really cryptocurrency and decentralized finance, not as much on the blockchain side. That used to be the old speech. Everything is all about blockchain, not crypto. Now I want to flip the coin and say, okay, today is the first, the real adoption, on the short term, it's for now crypto, not blockchain. It's based on blockchain technology, but we're not looking at long-term supply chain inefficiencies, bullwhip. We're really looking at disrupting the financial system. So just a quick background about what we do at Kaiko, where we had the pleasure, I had the immense pleasure of working with Mo for quite some time. So we were founded early on in 2014, and we started aggregating all this data coming from centralized exchange places that are basically like a New York Stock Exchange or a London Stock Exchange, where you have instruments that are being traded. So if you want to buy some Bitcoin, you go there, and that will be recorded in the trade. So this is what we've been collecting for many years, and what we do is we collect this data and then we distribute it to people who need this pricing data. So if you look closer, what it looks like is we connect to all those famous exchange places you can think of, where you might actually, some of you might have accounts there. We collect all the trade data, normalize it so that, because there's so many of those exchanges, from our client's perspective, getting data from one exchange to another is exactly the same. Then we store it and deliver it across the industry, to anyone who needs this kind of pricing information to analyze the markets. So what has happened to the trading infrastructure in the recent year, and even the past couple of months have been very intense from that perspective. So the first question is, how do those exchanges work? How does it work, even in traditional finance? If you want to buy an asset, how does it work? The most common way of trading an instrument is called what's called a double-sided limit order book system. So basically, you need somebody who's willing to sell and somebody who's willing to buy, and they in this process, prices form by having this matching between people who are willing to buy and people who are willing to sell at a given price. This is what the order book tracks, and this is basically just record keeping of supply and demand. So you have a couple of Bobs, and Bobs are willing to buy. They have dollars. You have a couple of Alices. Alices have Bitcoin or another currency they're willing to buy. Each of them have a price at which they're willing to buy or willing to sell. If there is a compatible price in the middle, right here, I don't see if I can put a pointer. If there is a compatible price in the middle, well, a transaction will form and you will get a transaction executed. When all the transactions have been executed, all the orders have been matched, you're left with this order book. And this is exactly how markets work. You have those bids, those asks, and we also keep track of this at Kaiko. So if you look at what they look over time, this is an averaged view of those order books. So you can see that the depth, which is the amount of Bitcoins that are available at each price level, changes over time. And this is what you can see on those exchange platforms, in that people try to look the shape of which to infer what the price changes are going to be, because in the end, prices in an auction type market, prices are dictated by supply and demand. So this is how traditional centralized exchanges work. Now, what's been going on recently is a lot more complex, because you have and this is one part which is often not very clear, in everybody's mind when you start looking at crypto, because you have those assets that are residing on chain. So my Bitcoin, I could get some Bitcoin. I have my Bitcoin wallet. I can store it in a secure way, maybe on the ledger, on another type of key, but it's on the chain, and I want to see the transactions on the blockchain. Will you see the transaction on the blockchain if you go to a Binance and buy some Bitcoin? The answer is no, you won't, because it's a centralized exchange. There's actually another marketplace which allows you to trade in there, and then they're reconciliating with the blockchain and making other on-chain transactions. But for you, when you are exchanging your Bitcoin, your dollars or British pounds into Bitcoin, this will not be information you will find on-chain. So this is how centralized exchanges work. Now, so these guys, so the centralized exchanges, and these are typically it's the easiest way you can buy crypto. And this is what many people, the Binances of the world, the Bitstamp in the UK, this is how people buy crypto. But now what we've seen recently is the rapid rise of decentralized exchanges and automated market makers. The specificity of those is actually their system is on chain. So if we go back to the order book, you have those Bobs and those Alices, and each of them had price levels. The principle of decentralized exchange is now, what if I'm Bob and I want to buy some Bitcoin at a price? Well, I'm going to send a transaction on a different blockchain saying, I'm Bob, I'm signing a transaction where I'm willing to buy this Bitcoin at this price. And there are Alices who also send transactions. And then in the mining process, miners will get the transaction and match them. And it's a decentralized way of matching these orders, as opposed to what you get in a Binance or Bitstamp, where you have a centralized matching engine, which is doing this job. So it's fully centralized as opposed to decentralized, where you have orders for transaction waiting in the mempool to be mined into blocks. And the brand new thing is the automated market makers thing. And this really revolutionized, as we'll see in the next slide, the user experience. It was, okay, how do I just, I have some Bitcoin, I have some dollars, I just want to get exposure, I just want to buy this crypto. Why is it so complicated? Why do you have to know what a limit order is, a market order? And I'm not even sure I'm getting the good price out of it. How do I do this as simply as possible? And this is exactly what Uniswap and all the swap suffixes have been doing. It's basically, you went from a complicated interface from a full-blown exchange to just, you want to swap what Ethereum or Bitcoin or wrapped Bitcoin for some technicalities to a different token. You just select the from, the to, the amount. You connect this to your wallet, so this will be your on-chain wallet, and that's it. It's being swapped. So this was really about redesigning the user experience and making things easier to use. Now onto stablecoins, because I said, well, I have some dollars or British pounds and I'd like to buy some Bitcoin, but how to get those dollars on chain? How do I get those dollars to Uniswap? That was really difficult to do. And also, as an example for myself, I'm based in New York City, getting paid in US dollars, but my family is in Europe. If I want to send money or get money to Europe, you have to go through settlements, you have to go between accounts, you're going to pay very high transaction fees, it's going to take time to send money. Well, what if I could have a digital version of this money residing on chain? Having this will make it perfectly interoperable with these kind of automated market maker system. And I can swap very easily because I have a virtual equivalent. So this is precisely what stablecoins are addressing. They're replicating and pegging a digital asset onto an underlying currency, and most often the dollar. But they're pegging it, so it's really trying to replicate and having something that is stable over time. And this definition of stable is also something complex. So let's take the simple case and just base it on the US dollar. So we're not talking about whether gold is something stable, or just let's take the US dollar. So the idea is you create a digital asset that is trying to represent as closely as possible $1. And as you can see on this graph, based on the type of on the stable coin, it's actually not always that close to $1. And if you look at DAI, which is a slightly different type of stablecoin, you can see you can have deviations as high as about 4% from this $1 value. Why is DAI different? The beauty of DAI is the way they're doing it. Most stablecoins, they're saying, I have a bank account and I'm going to show you, you give me $1, I'm going to issue you one virtual dollar. And every time people come to me and give me dollars, I'm going to issue exactly the same amount. And so there's going to be a one-to-one backing of with my reserves of how much I'm being given. And I'm only going to issue how much I've been given. What's different with DAI is actually a sort of algorithm which will use some other crypto collateral which is not denominated in US dollars and adjust it to maintain this value. So as you can see, the stablecoins are not as stable as one may think. Although this has been improving, there are also a ton of regulation issues. Recently, you can have a look at the Tether case, which recently settled. Well, I mean, where the regulators have advanced a lot on recently, where at some point it was discovered that Tether Limited, which is issuing those stablecoins, did not ensure a one-to-one backing of the coin. So they had made a sort of loan, or there were some very shady things going on, where the lack of transparency of the asset they were holding was not able to really ensure a one-to-one backing ratio. The second question about stablecoins is in terms of arbitrage, because those stablecoins, you can always get a stablecoin for $1 from the issuer. So this is the way it works, plus a little friction. So if you look at Tether, typically I think they have like a 10 basis point fee on fiat. So when you wire the cash to them, they take a little fee on this, and there are minimums. And but the idea is, if you're a big enough institutional actor, you could play this arbitrage with other exchange places to maintain the price at one-to-one. The question is are there a lot of arbitrage opportunities then when you look into the market, whether you're trading in US dollars or trading in USDT, being Tether? And what we looked at here was the correlation between changes in the order book by minute. So what you see on the x-axis is the USD pair for Ethereum, and on the y-axis the USDT pair for Ethereum as well, and on two different exchanges. So the only thing I want to show there is basically if there were really strong arbitrage opportunities, you would clearly see correlations with at different lag levels, or one would be sometimes delayed, and what we see here is basically if you are at the same timestamp, yes, there are correlation, which is normal. If you lag it by +1 minute or -1 minute on two different exchanges with two different quote pairs, you don't get much correlation. So the markets are not as inefficient as one might think, which is really what's beautiful about those stablecoins, is they've revolutionized the way those assets are being traded by making the settlement and the money transfer of those pseudo fiat currencies really easy to do and scalable. So now that you can bring your asset onto a platform and start trading on chain, or move money around, how do you what do you need to do to invest, and what is required there? And what we've seen in the crypto market is basically the growth of the most of it, the classic investing toolbox. So you have spot markets, derivatives markets, and at each step, the key is you have to go step by step to build the liquidity, to build people who are willing to trade at reasonable prices, and go into price discovery. And this is increasing a lot on the institutional side, especially recently. And so how do you take long positions, short positions? For if you want to take a short, whether you can borrow shares or cryptos from somebody else, you can also use derivatives. And all the lending and trying to extract yields has really skyrocketed in the past year. And why? Because the infrastructure has matured. The infrastructure has becoming much more reliable, and we're trying to avoid exactly what's presented on the first part of that slide, which is how do you get exposure? The easy way to get exposure to a market is via an ETF. So you go for an exchange traded fund like the S&P 500, which is very low fee and very cost effective. Now, the issue when you do that is if the underlying how do you price the underlying for the index? And if the underlying can be manipulated, you really get into a system which is not sound for people to allocate money to it. And so what Bitwise was having a look at about now a year or 2 years ago, about 2 years ago, was the data coming from those exchanges, was it real? Because now if I say I want to buy what I can buy 1 unit and then to a friend, let's say I have a buddy, and how do you assess the amount of trading going on the exchange? You look at the total volume, so the total number of bitcoins that have been processed on the exchange. Let's say I have my buddy and I'm gonna sell 1 bitcoin to my buddy, so that's going to be +1. Then my buddy will tell me, oh yeah, do you want to buy it back from me? That's going to be +1, so that's 2. And then I can sell it again to him, and that's going to be +1, so that's 3. And so there's this game going on some exchanges where you have non-economical trades going on, where they're inflating the volume. So those are not real trades. It's just they don't have whether fees or and they want to show people they have liquidity, which is not actual liquidity because it's not economic. It's not a real trading activity going on. So this is what Bitwise has been investigating. The other question is, now that we're starting to have more mature derivatives market, is fees on derivatives usually can be lower, and they are easier to trade with. You can get leverage much more easily, and in traditional markets, very often it's easier to trade using the future rather than using the spot market. So these are other things that are being investigated in terms of where are the prices discovered, as in what is moving the markets? Is it being discovered on the derivative side, on the spot side, on specific exchanges, be they located in Asia, in Europe, in where and what is going on? This is really important if you want to make a reliable investable instrument. Which brings us to institutional crypto, which is really what this year was sort of unexpected, I think, from a lot of people, which was seeing this much of institutional adoption. And this is what you see with network effects. It's always been about building the infrastructure. You might have heard of Paxos, which is a great example of this, of building infrastructure for financial services, for people to be able to deal with cryptocurrencies. And one sharp example of what improving infrastructure means is, let's take one of those exchange places called Bitstamp. They're actually located in the UK. And one day they were like, okay, look, we've grown quite a bit, and we need to have more people, more trades on our exchange place. Let's use Nasdaq's technology to match those trades. So what this technology is doing is exactly what we showed between Alice and Bob. It's taking all the bids and asks from people and then matching them when they're compatible. And what happened when they did that was the throughput that they were able to handle on their platform really increased. And you can see it from the market data, from the public market data. And what you can see here is when they rolled out in February, so here you can see the date. Actually looking at the data, you could even know at what hour of the day they rolled out the upgrades. So, and this is just one little example of everything that's been going on in making this infrastructure more robust and able to handle larger volumes. And this is what we're seeing right now playing out. And the question on decentralized finance is also the big thing coming up right now. But speaking about decentralized finance, the big question is, how do you interface all this? Because we have this, huge financial system we spent decades building. Some of it may well need to be upgraded. And as BNY Mellon says, it's all about using the same plumbing as what you're using right now, but finding interfaces that will bridge the two. No, it's not. I don't think it's necessarily about building a completely new ecosystem. I think building the connections between the two will be much more powerful. And another anecdote about traditional finance is there is so much legacy code that was written in COBOL in the 70s that hasn't been upgraded, and maybe crypto provides a way of upgrading that as well. Another example of the fact that we're still early on and there are still a lot of things that need to be figured out in this bridge, in those bridges, and consolidating the market, is this simple thing, as simple a thing as saying, is BTC Bitcoin, has not been trivial, because various exchange places have different names, and so sometimes you can have BTC, sometimes you can have XBT, like the ISO standard for XAU for gold, etc. So that's the same asset with a different name. Sometimes you can have Universe versus Uniswap, and now Uniswap is much more famous, but there used to be a coin called Universe, and in this case it's really bad because it means you could think you're trading on Uniswap, whereas you're trading on this Universe coin, which is completely different. It's not the same type of asset. So also getting more tools for metadata analysis and database matching is going to be important in the future. It's part of the infrastructure and is something we've been working on at Kaiko with OMD and Bloomberg. So looking for just a few jokes as well. I really think DeFi is incredible, and it's a clear and crisp illustration of network effects and the tendency for everybody to underestimate network effects. What's really fascinating about crypto is it's actually bringing a VC game to finance. VC venture capital used to be only open to a select few who had the connections, who had the access to the deal flows, and could meet the founders, and invest in them. And the type of returns that we see in cryptos are much more akin to VC network effects, and it's bringing something different. On top of that, you have now all those lending platforms which bring yield that your banks are not providing anymore. Your saving account is not going to get you where you'd like them to be. And bear in mind, you have lending platforms like BlockFi, which are offering close to 7–10% yield on stable coins, something that's meant to always be $1. Imagine you could have 7% from your bank. No, it's not even imaginable. But of course, there are risks there. And what are there? How can we quantify them? That's still an open question. Another great thing about crypto is I think neobanks showed the market fit and really illustrated the desire and the needs and financial health and financial. They really illustrated that, getting credit cards that work really well and easily with a beautifully designed app that's seamless and reducing all the frictions. And now with crypto banks, with actual banks being chartered in the US, I think we're going to see this product market fit that was identified pushed onto a new infrastructure, which is really exciting. The next exciting thing is this interaction between automated market makers, decentralized exchanges, and centralized exchanges. That's something really unique that's going on in terms of market microstructure. And what's going to happen there, who knows? But that for sure, a lot of those decentralized exchanges, one of the reasons those decentralized exchanges are interesting is, one, there is no custody involved. So the exchange is not custodying your funds. You always remain in control of your funds. And two, because they're not costing your funds, they're not regulated in the same way. So this is the sort of regulatory loophole they're trying to use right now. And because it's for the Oxford Blockchain Club, just thought I would mention, if you're interested in the space, have a look. There are so many companies hiring these days. Every day I see new other friends or contacts who are posting job posting on LinkedIn. So have a look. And then one last joke. So you might have heard of MicroStrategy putting a lot of Bitcoin on their balance sheet and creating an opening to more investment to invest in Bitcoin. So a lot of people have been joking they were sort of pseudo ETF in the market, and might seem like a stretch to think of an extraterrestrial fund, but now think about some people trying to put Bitcoin miners in space. What if you could run a fund in space on hardware? And I'll just leave it there. And oh yeah, one little plug if you're interested in the space. I've been an organizer of the MIT Bitcoin Expo, and this year it's going to be virtual, online, and totally free. So I'll give you the link if you want to have a look. Usually it's a very exciting event. And just parting remark is with all the craze that's been going on right now, two famous quotes. The first one is, a bull market is like sex, it feels best just before it ends. And the second one is very famous from Warren Buffett, which is, when the tide goes out, you see who was swimming naked. Although bear in mind, a good tide could sometime afford you a very good swimsuit. And so we'll see what will go on in these markets, but always be careful. It is true there is a lot of speculation, and I don't think cryptocurrency are just solely about speculation. Of course not. It's a lot about infrastructure and trying to rethink our financial industry. But there is definitely a lot of speculation, so be careful. And with that, I'll open the floor to questions, or Brandon or Mo, if you have anything you'd like to comment or mention, and more than happy to connect if you have questions, if you are wondering about what you'd like to do after you graduate, or any other things you have in mind.
Amazing, fantastic, Sacha. I think that was great. Mo's already quickly popped a question in the chat, I think. This is actually, I think this is crucial, especially going back onto what you said about regulatory loopholes. Mo's asked, what role do you think regulation will play in the adoption of cryptocurrency going forward?
So there are different. So there will be. So the new thing about crypto markets is they're completely global. So there is this fierce competition between countries, to not, and it's always the balance when you're a regulator. You want to protect investors, protect all the market participants. At the same time, you really want innovation. So what I would expect on the regulation side is hopefully more regulatory clarity, because it's really difficult if you don't know what the rules are going to be made of. It's incredibly difficult to build a business, because when the rules get set from one day to the next, your entire business model can be thrown to the bin. And so that's something that's really been hampering the growth of the crypto markets in the US in particular.
Yeah, I definitely echo that, because recently we've just had the Encode Club hackathons. They're a company that works fairly closely with universities in the UK. And there's always this fear of particular groups doing something that's really interesting and revolutionary, but they're thinking, if the government just changes the rules, a few days from now, what will our idea be? And all this investment we've received, what are we going to do? Ryan asks, so the total volume of Bitcoin transactions for the purpose of buying goods or services is dwarfed by transactions for the purposes of investment. Is it just a speculative asset at this point, or will it ever see mass adoption as a currency in the way its founders intended?
Well, I think the way it's playing out right now is really Bitcoin as a store of value. So not necessarily as a currency, more as digital gold. And Ethereum more as financial infrastructure. So with all the smart contracts that you can program to really automate all the interactions. And the key is in the interoperability. because it's all computer code, everything can talk and communicate between each other. So, Bitcoin is one chain, but then what we've seen on Ethereum and other chains is you can wrap one coin from one chain and build a connection to the other. So, the argument saying you can't buy you can't buy a pain au chocolat in Bitcoin, sure. But when not so long ago, you couldn't buy a pain au chocolat, especially in France, with your credit card, because because of the fees of the credit card, you had to pay in cash. And the other thing is, when you send money to your friend, you're not doing it via in the US they have the Fed wire, and you're not doing it through the wire system between banks. So that's more, you're doing it by a sort of layered solution, which is updated on the settlement infrastructure. So Bitcoin is really providing as well the settlement infrastructure to do settlement at a much faster pace than what's being going on right now. And I don't see it as really using it like a currency per se.
Yeah. Is it okay if I just stop your screen share just so?
Oh yeah, of course.
We can. Yeah, it's interesting you say, because there's also an interesting situation at the moment with decentralized exchanges in the same manner, such as Ethereum, with gas prices being fairly high, well, really high.
Yeah.
And many people not being able to take advantage of this amazing system.
Yeah.
But then there are alternatives like Binance have their own new one.
There's Binance, there's Solana.
Yeah, so I don't.
Well.
Do you have any particular comments on that? This is just part of the evolution, and it'll get there in the end, or will there always be this kind of barrier to entry?
So I think there are a couple of things. So the first thing, so Ethereum is the protocol. There are a lot of improvements going on in the protocol, and there's the EIP. Never remember the number, 1559 or something, which aims at reducing those gas fees. And there are other chains also that come into the mix. Namely Solana, which is cutting the fees by a tremendous amount. You have other things like chains like Algorand as well. I think the future will tell, but there are tremendous networks effect there. So once you find the good fit and the use case, and it changes the way things work, it's going to grow really fast. I think.
So Charles has just asked, can you briefly discuss thoughts on sustainability of Bitcoin, crypto, blockchain applications from an energy emissions?
Yeah. Oh, one quick thing about the other thing I wanted to mention is the other thing people forget about is, remember SushiSwap? They took the code from Uniswap, forked it, and it became SushiSwap. And then it's like, yeah, I just want to change the user interface. And so that's another factor to take into account in terms of the dynamics, and obviously it hasn't killed Uniswap, but bear in mind people could fork your code. As far as the energy is concerned, so it's a long debated problem. I think the biggest thing, and I think Nick Carter really articulates this very eloquently, is a lot of people look at cost per transaction. It's not how the Bitcoin network works. And think about gold mining during the gold rush, and people spent tremendous amounts of energy getting this mining this gold, getting gold, and today do we really know about gold mining? I mean, do we really think of this as a concern? So this is, I think, the analogy I would think of for Bitcoin. Yes, right now, and Bitcoin mining is not really profitable most of the time. because you have huge actors who act as utilities, so they can get electricity much cheaper. They don't get it like you do at home. So they pay something like a few cents, 2 or 3 cents a kilowatt hour, where you might pay 10, 20 cents. Then they have agreements with OEMs, equipment manufacturers, so they also pay the hardware cheaper. They have access to the hardware. Where mining is incredibly profitable is when the hardware, the hash rate, the difficulty that you need to put, the amount of work you need to put to get a Bitcoin, cannot increase as fast as the price. Why? Because prices can increase as fast as speculation goes, or inflows of capital, which is not necessarily speculation. Whereas mining power goes as far as humans are able to set up the mining facilities, and most importantly, how fast the equipment to mine it can be produced. And eventually the fee structure of Bitcoin is made so that the minting of new coins will disappear. So it will be more of a fee getting the miners get from maintaining the system. And so it's not something where you can have a look at how many transactions or how many and look at the price and say the price, the amount of electricity is going to scale linearly from this. It's not the case.
Yeah, and there's definitely also, as you say, like cost per transaction, also volume, the amount of capital you can move for, whether it's 1 billion costs the same as if it was essentially 1 penny, pretty much. Well, a bit more due to the data size of the blocks.
Yeah, and then you also have all the political aspects. How much goes into what the U.S. government has to do to make sure to make sure the US dollar is a reference currency. That's also some kind of work and energy, and which has even oil implications, military implications, and it's not always easy also to count for everything.
Yeah, it's true. Just a reminder, if anyone also wants to ask a question out loud, please just raise your hand and I'll quickly unmute you. There's no problem with that. So that's all. Yeah, that's always going to be an option. But I guess, yeah, it's strange. I just feel like you kind of touched on it at the beginning with possible market manipulation in Wales, and like, have people kind of found a hack to the system to just increase their returns on an investment, which is buy Bitcoin, tweet about it, and then watch the price go up? Or is there something more to it than that?
Well, so there are multiple things. I think even in traditional finance, we have to rethink market manipulation, because we are in a highly digital world, highly social world, where we have literally social instabilities that take place. And there are filtering systems, in the way we process social media and the way we process news, that create those instabilities, and that when they grow, they have impact on prices. And when you see what happened with GameStop, so it's not really manipulation per se, but and I think it's fascinating. I don't have an answer to this. It's what is even the definition of manipulation is not necessarily clear, and I think regulators will have to work a lot on this to protect investors and protect everyone, not to get into traps, because most often it's always presented in a way where it's, oh, the poor people, the big bad hedge funds, so they don't want you to do this because this is how they make their money. But there are double negatives out there as well. And it's yeah. So I think that's where regulators have a huge role to play, which is protecting and making sure they define clear what manipulation is and what it's not. But there are other things in terms of manipulation, and even in traditional markets, there have been actors where, let's imagine you have an ETF, or you have an index, which is calculated at a given time each day. You're going to have to execute X volume, and because you have a decent amount of volume to be executed, what if you time this to slightly move the index, or slightly move, well, then if you can have some predictable impact on the price, that's also something you can game and play on. So market manipulation is always a big concern, and it's even more acute in crypto, because in some of those markets, the liquidity is not there.
So where do you think we go from here? Because something like Uniswap, it's such a simple algorithm when you think about it, this automated market maker algorithm, but it could, well, yeah, I mean, it's changed, finance. And we see other blockchains such as like Avalanche with the tagline of the Internet of Finance, and things like Algorand. And there's essentially, crypto has gone from, a pseudo-anonymous person or group, Satoshi Nakamoto, to actually quite big academic actors, producing really good work in this space. Do we see, or do you see a world where, in fact, you have, stocks on the NASDAQ actually trading on something like Avalanche or a Uniswap version 10?
Well, the beauty is you can synthesize things, because now you can create synthetic assets. So yeah, I do think that's going to be part of the answer to this. A lot of assets are going to be synthesized. They're potentially, very, very long way down the line. What if you could get some of your Fitbit data on chain, and that had some implications, like you have now people trying to do NFTs to value people, to value individuals. What if somebody could arbitrage out your value as a human being, because they know you're very smart and you're going to do well at school? I think that's frightening, but how is this going to evolve? And in a more practical and short-term sense, SIX6 in Switzerland, I think they've been working a lot on upgrading the financial infrastructure, and this Swiss regulators have really gone a long way in making sure they understand and pave the way for this. So how are they going to trade those digital assets? How are they going to make the digitalization of those assets? Who knows? But it's coming.
Yeah, and I guess probably the end result is that, as a user, you probably aren't even aware about what it's even running on. In the same way we don't think about anything running on IP, or TCP at the moment. It's just sending an email, sending a text message,
Yeah, and there is also a lot of democratization of finance, and not finance, trading, and people want to learn how to do this. And because now we're starting to have the infrastructure, we don't need to be trading all day, or have that much knowledge to be able to get exposure to those fields. And that's really what the fintech space, the fintech scene has seen over the past decade or so.
I guess finally, because we're coming up to the last few minutes of the event, is what do you think? Oh, actually, no. Let me give Mo's question again. This is better than what I was going to ask. Do you think Tether will collapse? And what impact do you think it will have on the market if it does, given its significance in volumes of transactions?
Well, so would it collapse? Collapse as it? Well, I think it would be more of a dynamic play how that would work. How, and how would people? I don't even know how people be able, how would people redeem if anything happened from a regulations perspective? I don't think that would be in the interest of having Tether completely collapsed. What may happen is having other coins like USDC or just gain market share and trading instruments being redefined with those stable coins instead of Tether. And progressively eating out market share from Tether. Not necessarily just Tether collapsing from. I mean, if tomorrow they're being audited and suddenly, which I don't think it's the case at all, but if tomorrow they're being audited and everybody discovers that half of the assets are missing, yes, potentially you could have a bank run on Tether and everybody trying to redeem their Tethers, and the price would go down. But apart from that, I think it's more how it's going to be. It's going to be eaten out in terms of market share.
One other thing on stable coins, or even algorithmic stable coins, is that I often wonder, there's this talk of essentially you can exit traditional finance in a sense, by having access to cryptocurrency markets. Whether it's Bitcoin, Ethereum, DAI, sushi, whatever. And the role of, the state and the government has, been essentially by fiat to decree and issue currency. But if, people have this option, what happens? Like, what is this pathway to where we're going? Because it sounds like essentially, if if anyone can just exit, what is the role of these huge institutions that have essentially controlled monetary supply for a very long time?
Well, I wouldn't also like in those traditional institutions, they'll also have, they can be nimble at times as well. You can build new services, they can acquire, they can do M&A, and get services in-house. So I wouldn't underestimate this. But yes, I mean, what you're saying is, okay, what would prevent people from moving to a better infrastructure? And yeah, that's 100% true, and that's what people are trying to do. The question, the big thing about stablecoins is when it meets CBDCs. The major difference with a CBDC is the central bank digital currency.
Yeah.
The central bank digital currency, you actually have some form of liability on the balance sheet of the central bank, which is, whereas the stablecoin is just something that is pegged to that liability. So but I mean, do you need it to be an actual liability? And when you look at Avanti, I think they're doing some sort of atomic transactions with actual dollars. Well, then you have this perfect emulation of the central bank currency underlying it. Yeah, we'll see how the CBDC game plays out. What's really fascinating is the distribution power central banks have, because moms and pops don't have to open, like if the government comes to them and say, well, look, you can use my digital currency, it's not the same psychological shift as to like getting into crypto.
Yeah, that's very true. And also I guess maybe that will then more affect the retail banking industry, right? Because the central banks can almost work direct to consumer.
Yeah, and the other question I'd raise, and I don't have an answer to it, but what would are stable coins and this kind of digital currencies actually good for the US dollar?
Ah, because they're all pegged to it.
Because yes, I mean, in a sense, they're pegged to it, and in another dimension, they, to some extent, some of them bring more transparency and more
Yeah.
means, more data, more means to see what goes on in the transactions. And more importantly, when you look at the trading activity right now, it's completely dominated by US dollar stable coins. It's not really representative of what the volumes you get on traditional markets with other currencies. Most of the trading is with US dollar stable coins.
Yeah. This is true. This is very true. Oh, interesting stuff. That's I think that's flipped a lot of things on its head right there. I don't think a lot of people think about it that way. They just think, oh, great, this is a great way for me to cash out my crypto, make sure the value is stable. They don't think, oh, hang on a sec. Am I supporting
Yeah.
the same entities I claim to be, rallying against? Who knows? But I think on that note, we'll end the event and the meeting. But yeah, thanks for that, Sacha. That was brilliant. A nice pace, covered a lot of bases there as well, from just typical finance to Uniswap and clones like Sushi Swap. So yeah, getting claps from the participants. We love to see
Thanks.
that.
Really a pleasure. And no, as I said, I think it's a very open space. It's still early, and people are quite open to interacting and raising these kinds of questions. So yeah, happy to get in touch.
Yeah, is there anything you want to drop in the chat, whether it's a Twitter or an email or a website, just in case people missed it off
Yeah.
the screen?
So I think it's too hard to find me on Twitter. Okay, on Twitter, I'm not very active on Twitter. I'm not too much of a social media person.
You're not alone.
Yeah, I like,
Neither am I.
yeah, I don't like definite answers to things. I prefer questions. So so yeah, so I'm SGHEB, or you can just look up my name and find me on LinkedIn, and Sasha at Kaiko.com is also easy.
Awesome. Thanks for that. Well, yeah, that's it, everyone. That's officially, I think, our last event for this term. So also massive thanks to Mo for organizing this and reaching out to Sasha. It's really nice to have a different flavor of events from the usual AMAs. I think that was a nice hybrid combination of slides and Ask Me Anything is what we really
And
like to see.
thanks for great questions as well, and you, Mo, and you for, was really smoothly organized. Really appreciate it.
Awesome. But yeah, so for the time being, if you missed any of our last events, you can catch up on our YouTube channel. That includes Crochet K, an AMA with Anatoly Krachalov. We also had a joint event where we had an AMA with CZ. So there's lots of stuff up there which you can watch. But other than that, I think have a great evening or afternoon or morning, depending on what time zone everyone's in. And yeah, cheers. See you next time.
Cheers.